So I'll talk a bit about my opinionated view on the role of incentives in the contribution to credit booms. So the big picture, or the outline, what I want to talk about is first a bit of a big picture introduction, then talk about executive incentives and their contribution to risk-taking during the financial crisis of 2007, 2009, and then I'll go a little bit like a step up and think about also non-financial incentives that might have actually contributed to the recent financial crisis. And so if you want a big picture, there is substantial evidence that credit expansions have severe consequences for the real economy. I didn't put any sites here because I was worried I would forget somebody from the audience, so you have all contributed to this. But the question then becomes, to what extent do incentives, like either financial or non-financial incentives, contribute to those credit expansions? And another question that always comes up here is the risk-taking, if you want, that is induced by incentives excessive? So do we have some measure of excessive risk-taking? And when you talk about excessive risk-taking, I think it's very important to define this. So if you want, there is an important distinction to be made. The first one is, was this excessive risk-taking vis-a-vis shareholders? So what do I mean by this? Was it that there were financial incentives for key executives in the bank that led them to focus on short-term result, and if you want, to pursue projects that were in expectation negative NPV projects? So that this actually destroys shareholder value. And the second point of excessive risk-taking is a little bit more subtle, and there we talk about excessive risk-taking vis-a-vis society. So was it the case that, bankers and shareholders, they never fully internalized the systemic risk externalities? So you can have risk-taking that is optimal for shareholders, but also socially excessive. And I want to talk a little bit about this. All right. What I'm going to do is I will show you mostly results using data on financial incentives to provide it to bank CEOs during the recent crisis. And mainly I'll do this because of data availability. So you should not read a statement in there that I think bank CEO incentives are the most important ones, or the most recent financial crisis was the most important one. Okay. So to start with executives' incentives and their contributions to risk-taking, let me just give you an overview of what the compensation of a typical US bank CEO looked like at the end of 2006, just at the onset of the financial crisis. And just perhaps to show you that this was really important, here are a couple of quotations of influential people who have thought about the executive compensation. The first one is from the US Government Committee on the Causes of the Financial Crisis. And they state, compensation systems too often rewarded the quick deal, the short-term gain, without proper consideration of long-term consequences. Often those systems encouraged the big bet. This was the case up and down the line, from the corporate boardroom to the mortgage broker on the street. Secretary Guyton at the time said, this financial crisis has many significant causes, but executive compensation practices were a contributing factor. And Alan Blinder in the Wall Street Journal, in an important piece, said poor incentives are one of the most fundamental causes of the credit crisis. So it was really the issue that incentives were just wrong in the financial sector. So if we think about the poor incentives and the credit crisis, there are at least three different versions that people are talking about. The first one is that there was really too little focus on shareholder value. It was this idea of a big bet. You would get big cash bonuses. If you went to the casino, you put the money on 35 and you actually won. The second one is a recognition that bank shareholders actually had incentive contracts with bank executives that gave them a lot of equity. However, the equity grants were ill-designed. They had relatively short vesting periods, and CEOs could really cash them out if shareholders did not fully realize what was actually going on. And then the third point of the poor incentives version was that there was a lot of option compensation, and this option compensation introduced convexity, and that could lead to additional risk-taking. So let me assess these three different versions of the incentives explanation by just looking at a sample of banks. So this is from a paper that I co-authored with René Stolz, in which we essentially asked how closely are the interests of bank CEOs aligned with those other shareholders before the start, with those of shareholders before the crisis, and what can we say about these different versions of the crisis. So what is this? This is 95 US publicly listed large banks, essentially the 95 banks that are part of the 1,500 largest companies in the US. They cover something like 80% of the banking assets in the US, and this is a reflection of having easily available compensation data on them. So how did this look like? The average CEO in the sample got a total compensation of roughly 8 million. Out of this, we had a salary of 760,000, a cash bonus of 2.1 billion, and then the CEO got an annual stock grant of 2.6 billion and a dollar value of an annual option grant of 1.6 million, and then other compensation. This is retirement benefits and so on and so forth. So if you look at those numbers, there are a couple of things that you want to retain. The first one is that the salary is relatively small to total compensation, so the cash salary is small. The second one is that the cash bonus is relatively large in comparison to the salary. Okay? The one thing that I want to emphasize is when you think about executive skin in the game, then these two numbers, the annual stock grants and option grants, are relatively small fractions of the total equity that CEOs actually have because they accumulate over time. So how do those look like? In this sample of the 95 largest banks, the average CEO had 88 million of equity in his own bank. What's interesting is that most of this was fully vested. So at the end of 2006, these CEOs could have sold 62 million of those 87 million. The other thing that you see is the value of exercisable options was 17.4, so you have to add this. And this is something that will become important later. So we have executive skin in the game of 88 million, out of which 78 million could have been sold immediately. It's really only that you had kind of something like 8 million that was either unexercisable or it was unvested restricted stock. So much of this was actually available. And also, if you just try to capture some ratios here, so this is what I said, much of the equity was voluntarily held, but we also find that the value of the total equity portfolio relative to total annual compensation, or the value of the shares relative to salary, was actually very, very large. So there was a substantial skin in the game for CEOs. Now, if you want, let me just break down a bit the debate that had happened in the literature with a simple example. So if I go back, so Dick Fuld and James Kane were two very prominent CEOs in our sample, let's put it that way. And Lucian Bebchuk from Harvard Law has made this point that they are exemplary about everything that was wrong with incentives in banks. And his argument goes that, like, look, between 2000 and 2006, both James Kane and Richard Fuld were kind of long-term CEOs. They had an enormous opportunity to cash out. Right? So James Kane got 87 million in bonus, and he sold during this period 289 million in stock. Similarly, Dick Fuld got 62 million in bonus, and he realized 461 million by selling stock of Lehman. And the idea here is to say, like, look, obviously they had short-term incentives. They could take lots of risk, and then they were getting out really, really quickly. And so this is somehow evidence that that was an invitation to excessive risk-taking, because they could liquidate their positions relatively quickly. However, what this is kind of forgetting is that there was something going forward. And so if you look at 2006 to 2008, what has happened is that James Kane lost 950 million on the vested equity positions. So everything that he had in December 2006, he sold very little. And the same thing happened for Richard Fuld, where he lost 912 million during that time period. And the debate is a little bit about, well, aren't these really, really large numbers, or are these really, really large numbers? Let me rephrase this. In some ways, what you want to ask is, standing in 2006, can you defend a model where somebody willingly and knowingly took excessive risks if he had almost $1 billion at the line? Is it consistent? So that's the question that you need to ask. And in some extent, I mean, I put my paper here, and so my opinion is that yes, this is a lot of compensation, but you can't really think about kind of them willingly and knowingly taking excessively risk if you have so much equity in your bank and that equity is fully vested. So if you just kind of benchmark this with simple summary statistics, what is it actually that you have on the line? So looking at cash bonuses, if you were to exceed the short-term goal that your compensation contract were to give you by 10%, you would increase your total annual compensation by 0.25 million. If you, through the equity that you were holding, were increasing bank value, the stock value by 10%, you stood to gain 11.2 million. And if you, kind of through the option compensation, managed to increase the volatility by 10%, which would be huge because pre-crisis we had a volatility of 20% going to 30%, you would increase kind of your own wealth by 1.9 million. So in some ways, it is true that equity grants had very short vesting periods. So they were vesting linearly over 2 to 4 years. But that didn't mean that CEOs, bank CEOs in our sample actually sold them. They were holding on voluntarily to really, really large stakes of equity. So these are the numbers. And what you can then do is kind of to try to understand whether putting ratios for the cash bonus, for the long-term equity incentives, and for option compensation in a regression where you're trying to understand what actually happened. So what we did in our paper, and there are many other papers who have tried to do this, is to take on the left-hand side on the regression a measure of bank performance during the crisis. So for us, it was buy and hold returns from July 2007 to December 2008. And on the right-hand side, as explanatory variables, we put all of these variables in there. And what you find is that short-term or the cash bonuses cannot explain much of the compensation. Option compensation cannot really explain much of the performance of banks during the crisis. But the equity grants surprisingly have a negative correlation. So it means that bank CEOs that had a lot of skin in the game, those banks actually performed worse and not better. So it's precisely the opposite of what you would be thinking if you wanted to think about incentives in the game and being kind of cautious. So one of the questions here then becomes, well, the idea that long-term incentives help you to maximize the stock price and is an alignment of incentives required that stock markets are efficient. But perhaps they were not particularly efficient. So if the stock market was inefficient and if the market might put more weight on these short-term results, well, then CEOs might have concluded that they really have no choice but to focus on short-run profit maximization. And they needed to do this to keep running or to keep dancing while the music is playing. Now, if this is the case, however, CEOs knew that they were taking risks that were perhaps not optimal. And so one of the things that you can do is to say, like, okay, once things started to turn, look at the trading behavior of CEOs. What happened with their own shares that they had in the bank? And this is something that several people have done. And what you find there is that there was really kind of not much trading starting from 2006 to the end of the crisis of 2008. So I showed you that our sample CEOs had something like 61 million in equity, and they lost half of it. So they really held on to their equity and didn't sell much in anticipation of the crisis. There's some evidence that subprime active banks started selling a little bit earlier, but this was only a tiny part of the equity that they had. So what is it that you want to take away from this? It is that bank CEOs really had strong incentives that were aligned with their shareholders and that they did not sell much of the equity, which suggests that they didn't really see the crisis coming here. Now the question is, this is bank CEOs, what about other employees that we had, and there's a fascinating paper by Cheng, Reiner, and Zhang. And so what they are looking at is securitization agents. And so what they have is they went to the attendee list of the 2006 American Securitization Forum. And what you have here is, these are securitization agents, people who are really, really close, who do the securitization of mortgages. And what they then did is they took this list of attendees and looked up the personal home transaction of these securitization agents. And what you find is that these securitization agents weren't much aware of a housing bubble either. So if you look at this, they, if anything, increased rather than decreased their housing exposure during the boom period. So it's even people who are very close to the crisis didn't really trade in a way that would suggest that they saw the crisis coming or that there was a lot of excess in what they were doing. Okay, so what do we learn from the evidence? Bank CEOs had incentives to maximize shareholder value by the usual standards. When we think about alignment of incentives, we think about skin in the game. Bank CEOs held on to sizable equity packages and didn't trade much just prior to or during the crisis. And to me, this is really the most convincing evidence that we have, that bank CEOs did not willingly and knowingly embrace risks that were ex ante, not in the best interest of shareholders. But the question then, of course, is why did they do it? Why did they hold on to it? And then we get again into the area that they just believed that they were maximizing shareholder value and that they were taking risks that were optimal. Okay? And I guess we have a session afterwards about beliefs and expectations, so let me not say too much about this. Good. Now, of course, you can also have a little bit more cynical view of this, and this is the following. Many other papers have looked more broadly at corporate governance during the crisis. And you find kind of the same surprising results. You find that banks that had kind of more independent boards, banks that had more financial expertise on the board, banks that had more powerful shareholders, you take these measures that we typically associate with good governance and you correlate this with bank performance during the crisis, and you again find a negative correlation. You find that those banks that had better governance performed worse during the crisis. And one interpretation of this is, well, again, banks do before the crisis what shareholders and managers thought was valuable, but it could, so first of all, to me, what this means is that it's not really kind of the fundamental problem here is not shareholders on one side and management on the other side. So the traditional corporate governance problem, how we typically talk about corporate governance, that doesn't seem to have been the big problem in banks. The incentives here were somehow aligned. And what does this mean? There were some policy proposals, such as more financial expertise on the board of directors or shareholders say on pay, and they seem to not go at the right problem because that's not where the issue was. I think that the shareholder and managers were aligned here. But so how do we interpret all of this evidence? And this is the cynical view that I was alluding to earlier. It's the perspective of taxpayers or the economy. Shareholders don't really take into account systemic externalities, and one of the explanations, or at least an explanation that is consistent with the evidence that are provided here, is that knowledgeable shareholders, managers, and directors exploited the implicit or explicit bailout guarantees by the government, and so together, collectively, took a risk that might have been too large or societally too large because they knew that the government had essentially a put option behind them. But if you want, if this is something that you're concerned about, then regulation or incentive design really has to force you to internalize those externalities. And there is some research that goes into this and that I thought I should briefly present. This is the idea of inside debt. So what you have with inside debt is essentially the sum of all debt-based compensation, defined benefits, deferred compensation that you would forfeit because they are unsecured and unfunded liabilities. So if you make the CEO in some ways a debt holder, does this make you more cautious? And there is some evidence that this has actually happened. So banks that had more causality is tricky here, but at least as an association, banks that had high inside debt CEOs, they were more cautious with respect to risk-taking in the build-up of the crisis. And if you want, this is something that has been implemented, for example, in Switzerland. So in Switzerland, Credit Suisse and UBS got big government support. And in 2015, this is from the Credit Suisse annual report, essentially the top management of Credit Suisse was paid in cocos. That would, so that some of the bonus was essentially in debt instruments that would have been forfeited if Credit Suisse reached the trigger for these contingent convertible bonds. So this is interesting that at least in Switzerland we have seen this. Now, in internalizing externalities, the Squamley group has made some of the proposals, and it goes back to this idea that you want to think about clawbacks so that you can get some of the money back. You want lockboxes, and you want the compensation to be forfeited if the bank gets into trouble, to have long-term deferred compensation. Okay, so let me perhaps talk for the last 2 minutes about the due diligence and monitoring incentives during boom time. So take it away from the financial incentives of the executives and take it one step up. Now, it's easy to kind of see a role for incentives here, and if you think more broadly about reduced credit quality. And what I mean here is in a strong economy, bankers may not be as concerned about default because their default feels remote. Even if default happened, they could sell the collateral easy. So perhaps investment discipline or the incentives to show investment discipline might actually break down. And most of the evidence that we have here comes from the work on originate to securitize mortgage lending, where the main issue is that the increased ability to securitize loans is potentially problematic because of reduced originators' incentives to do due diligence. There is some work by Keys, Mian, and Sufi. Let me not go through it because we have talked about it before. Rajan, Zero, and Vic show that this is going to be mispriced. But in the end, we see from these studies that kind of the investment discipline might have broken down a little bit. Now, do we actually have evidence on financial incentives for these, for individuals that were at the core of the origination business? And there's surprisingly little evidence. There are 2 clinical studies where people got their hands on data from an Indian bank and a large US bank, which decided to have kind of half of the loan officers to get performance fee for loan originations and the other half not. So we have kind of this controlled experiment. And perhaps what's not particularly surprising here is that, well, when origination volume is rewarded, loan officers approve more application and the credit quality declines. The quality decline stems from a reduction in soft information production. So hard information that the bank system can easily verify, that stays the same, but you dig a little bit less deep and you give at the margin loans, originate loans that you wouldn't have done. And the Ecole, Hanson, Clapper paper shows that a contract with a penalty function for exposed poor loan quality that actually increases the screening effort. So you can undo some of this effect if you have this penalty function. So let me conclude here. So what do I want you to take away from what I said? So incentive-induced risk-taking really was not excessive vis-a-vis shareholders. I think this is just this bad incentives or excessive risk-taking that destroyed shareholder value is not consistent with the data. Incentive-induced risk-taking probably was socially excessive, and this is where kind of regulation efforts should start. In boom times, investment discipline may break down because incentives to monitor, screen, and to screen are not high. And then what I showed you, financial incentives for these rank and file employees potentially amplify the problem. That's all I have. Thank you.
So I really enjoyed reading this paper by Rudy. So So let me just I'll just quickly summarize and then offer a couple thoughts on this. And by the way, I'm not myself an expert at all on compensation or incentives. So therefore, I'm going to have a bunch of very strong opinions about this. Okay. Okay. So did misaligned? The big question here is did misaligned incentives drive excessive risk taking that contributed to the global financial crisis? The kind of conclusion here, one possibility is there's excessive risk taking because bank executives had incentives that were not aligned with those of shareholders. Conclusions here, there's little evidence that executives knowingly took on excessive risks. Little evidence that CEOs that seem to have better aligned incentives took less risk. And if anything, there's some kind of surprising evidence that better governed banks or CEOs who had stronger incentives actually took more risk. Another kind of big question that people would talk about was there excessive risk-taking because lower-level employees within financial institutions had risk for risk-taking? You could think about the incentives of traders, loan officers. In general, just a lot less is known here because we do not have the relevant data on those specific actors within financial institutions. But overall, there is some evidence that banks that have stronger risk management took less risk. And as Rudy just mentioned, there's evidence that completely unsurprisingly, if you reward loan officers for origination volume, they originate more with lower quality loans. Okay? So before talking a little bit more about the paper, I will just offer my overall view about the crisis, what drove it, and then to put some of the role of incentives in line. So, my overall view is that, and this is consistent with the Minsky-Kindleberger view, is that what drove the crisis was a massive credit-fueled boom that was largely driven by overly optimistic beliefs. But those beliefs were those overly optimistic beliefs were shared by households, financial intermediaries, and shareholders alike. So there wasn't one group of people who was not in on the joke. Everyone was in on the joke. Okay. And then secondly, we had an inadequately regulated financial system that was not built to withstand the moderately large initial losses that were generated by subprime. And as we discussed, insufficient capital, overly reliant on short-term funding. There was no way that you could have an orderly failure of a large intermediary. And then a lot of these problems were exacerbated by the fact that there had been a lot of migration of activity out of regulated intermediaries into even more lightly regulated markets. And there was also a lot of market-based amplification mechanisms that once the initial shock hit were a lot more powerful than I think anyone understood. So I think, like Rudy, my overall reading is that bad incentives taken in isolation probably played a secondary role in terms of driving the global financial crisis. That said, I do think that bad incentives made a non-negligible contribution. But I think the most important incentive problems that probably played an important role are pretty endemic, pretty intractable, and I'll discuss this, are probably something that are part of something that looks close to the second best solution that we're probably stuck with in some sense. And I'm relatively skeptical of the idea that we can do a much better job of safeguarding financial stability, largely by improving governance at financial institutions. The other thing I'll talk about is I think as academics, we tend to either say, and I'll pick on two people from my university. So if you're Lucian Bebchuk, you would say the financial crisis is 100% explained by bad incentives. And if you're Andre Schleifer, you would say it's 100% explained by bad beliefs. Okay? And I think in reality, the two are less separable than we normally think. And there's somewhat of a chicken and egg problem. They go together and can reinforce each other. And so thinking through and understand some of that, I think is something that's important for the literature going forward. Okay, so in terms of on executive compensation, what Rudy discusses in the paper, I'm also quite skeptical of the inside job view that executives basically knew that the system was a house of cards and knowingly and happily just drove the bus off the cliff. Okay, to me it just doesn't pass the smell test. I normally think of CEOs as overly optimistic and overconfident types. This is consistent with the fact that they are holding on to very large, undiversified positions in their firms when they need not to, but not as evil geniuses. And also all the evidence about how they traded on their own account just basically suggests that they themselves were kind of closer to true believers in the boom rather than people who kind of knew that this was going to happen. Okay. Similarly, I'm pretty convinced that executive compensation practices probably explain little of the cross-section of risk-taking in the crisis. So for instance, and sorry if anyone here works at Citigroup, but like Citigroup took a lot more dumb risks in the crisis than JP Morgan did. I'm pretty sure that had about absolutely nothing to do with the difference between Chuck Prince and Jamie Dimon's CEO compensation contracts. Okay? That said, I think proposals like having clawback periods, asking managers to hold inside debt, they still strike me as sensible, but I wouldn't put a lot of stock in them and kind of in terms of the thing that's going to stop the next crisis. And also relative to what I understand, I would keep the rules a lot simpler than what they've become. Okay. Now, this kind of big puzzle that comes out of the literature is, why does it look like better governed banks actually were taking more risk? Okay. And you think about it, and so this is something we all probably in this room think about this a lot today. Corporate governance can be a double-edged sword. So in a super frothy market, there are costs to aligning incentives with shareholders' perceived interests. Okay, if the person who's in charge has a couple of screws loose, you don't necessarily want everyone to be following that person's instructions. Okay, and if you think that shareholders are if you think that the kind of world has temporarily lost it a little bit, aligning my incentives with that might not be the good thing. So, you can have and this is what people in behavioral corporate finance would call catering. So you have, where despite my kind of best judgment as a banker, I might say, I've been around, I've seen kind of these credit booms before. Gosh, it doesn't feel like we should be making loans to these subprime people. But shareholders are giving me very strong incentives, and I kind of may have no option but to give them what they want, which in this case is an expansion in low quality lending. Okay? Even if I kind of think that it's somewhat contrary to their long-run interests. Totally analogous to the idea that there was lots of equity fund managers during the dot-com bubble who thought, gosh, stock prices are getting kind of high. I don't like to be long the market here. But they had to be, because if they weren't, they would actually be fired. Okay? So this is kind of Chuck Prince's, as long as the music is playing, you've got to get up and dance. And actually, I looked, the day that he said this, it's not, like, if the stock price didn't go down the day he said this. So I think the shareholders were still fine that they were dancing. Okay? It also creates, this kind of dynamic creates a little bit of a race to the bottom dynamic. So it's harder for Chuck Prince to say no to his shareholders if the CEO at Merrill is still saying yes. And kind of anecdotally, some of this desire to kind of keep up with the Joneses, to be as profitable as your competition, seem to be playing an important role. Okay? From a policy perspective, these to me strike me as pretty endemic problems. I don't think, we probably need executive compensation. We need executives to have skin in the game to combat standard agency problems. And it's hard for me to imagine that you could really reduce kind of these short-term catering motives by, lengthening lockups. Even if I held a bunch of restricted comp, a CEO who doesn't cater is still going to worry that they're going to be fired or thrown out of their job. So you kind of may be stuck with this problem. Also, I worry a lot that public companies and markets are too short-term, but I worry that human beings, that Homo sapiens, are too short-termist. So I also don't think that this is a problem that we're readily going to be getting rid of. Okay. Let me talk for the last couple of minutes just about the interdependence between beliefs and incentives, and I think of this as kind of a little bit of a chicken and egg problem. So first is, I think there's a way which also often bad incentives often lead to bad beliefs. And the way that this kind of arises is, if I give an agent strong incentives to do X, the agent often ends up thinking that X is good or optimal, regardless of what they thought in the first place. So for instance, if you ask me, write a white paper, an industry group hires me to write a white paper about financial regulation, what will I actually end up believing about regulation? It might actually be quite different than if I was asked to write a paper that was skeptical of regulation, okay? So this is probably, structured finance is probably a leading example where we gave them strong incentives to think that these things were safe, and they actually ended up truly believing that they were safe. So bad incentives can actually often lead to bad beliefs. In terms of bad beliefs leading to bad incentives, this is much easier. If a manager has bad beliefs, they will set up within their organization bad incentives. So they will weaken their risk management department. They will, set up compensation contracts for their loan officers that don't make much sense at all. Last thing I want to say is I think there's a lot of evidence that our beliefs are shaped significantly by the past experiences that we've had. And there's a lot of evidence that our past firsthand experiences with credit booms kind of shape the way that we think about them going forward. In particular, there's both people and organizations seem to learn from what happened to them in the past. And that's probably because the past shapes what they believe, and then they set up better incentive structures the next time. And I think to me, the implication of this is I think this kind of has implications for stabilization policy, is that kind of overly eager or overly reactive stabilization policy can actually be kind of counterproductive, because if we're always kind of smoothing out the normal bumps in the road, policymakers may kind of be encouraging over-optimistic thinking, overly lax risk management, and that may be kind of sowing the seeds of future crises. So kind of in that regard, I would be somewhat kind of worried about the fact that it seems like the markets currently have the FOMC by the collar. So with that, that's it.
When the CEO, first of all, this is a fantastic discussion. I really appreciate it. When the CEO, one of the two that you got the email or the memo from the risk management officer that said subprime defaults are up this much and they mean this and they could potentially mean that for our company, was he at that point foreclosed from being able to sell his interest in the company because he was trading on inside information?
Yeah, so that's a question that we have gotten before, and the timing was later. So you could have between December 2006 and the very least kind of July 2007, you could have still realized some of the sales. But it's true that towards the end, when there were visible problems in the corporation, to then trade on it.
Let me be more precise. These CEOs would have seen Bear Stearns closing its mortgage derivative.
June 2017, yeah.
No, July.
July.
No, that was April 2007. April 2007. So at that point, could they have been, if they had sold, could they have been accused of insider trading?
Yeah, so this would have been more difficult for them, yes.
Okay.
I guess question to both of you. Where does this leave us when market discipline fails when it matters most?
I mean, I'm sorry, not that I want to rebut your paper, but this is actually why I want banks to have pretty conservative capital structures, lots of equity. I want financial institutions to be pretty conservatively capitalized because I'm worried that they may do dumb stuff, and when they do dumb stuff, I don't want them to break the world.
It could leave you with regulation and supervision.
Yeah, no, yes.
I mean, just to state the obvious.
Yeah, but that's what I'm saying. Regulation and supervision. That's what but conservative balance sheets, high capital, not excessive amounts of liquidity transformation.
That's what the Squam Lake report would have said, that to internalize the externalities, kind of to have more capital, critical situations.